You ever wonder if there's like one single number that could take the temperature of the entire global economy? A kind of secret signal that tells you what investors everywhere are really thinking? Well, a lot of people think there is, and today we're going to dive into one of the most fascinating indicators out there, the gold to silver ratio.
So to get a handle on this signal, we first need to understand the players. And this isn't just about two boring commodities, okay? This is a story of two very different personalities, two ancient rivals that are still competing for a place in your wallet today. And that whole story really kicks off with this fundamental tension. The author Robert Kiyosaki, he nails it right here. He frames this as a battle between government-printed currency, what he calls counterfeit fake dollars, and precious metals, which he calls God's money. This is the core debate that sends a lot of investors running to gold and silver in the first place. So let's meet our two main characters. On one side, you've got gold, the king. It's seen as the ultimate safe haven, right? A stable store of value that central banks just love when fear is in the air. And on the other side, you've got silver, the workhorse. I mean, this stuff is the second most used commodity in the world, right after oil. It's an industrial powerhouse, totally essential for everything from solar panels to EVs. It's way more volatile, sure, but its fate is tied to innovation and growth. Okay, so the relationship between this king and this workhorse, it's not random. No, it's measured by one single, powerful number that investors watch very closely. So let's decode what this ratio really is.
It's actually incredibly simple, you know? The gold to silver ratio is just a way to measure their value against each other. It tells you exactly how many ounces of silver you'd need to trade to get just one single ounce of gold at whatever the price is today.
For example, back in early 2023, the ratio was sitting at about 85 to 1. That just meant you could take a stack of 85 one-ounce silver coins and swap it for one one-ounce gold coin. Simple as that.
And hey, you can figure this out yourself anytime you want. It's just a simple three-step process. You get the current price for an ounce of gold, you find the price for an ounce of silver, and then you just divide the gold price by the silver price. Boom, that number you get, that's the ratio.
So how do investors actually read that number? Well, the general rule of thumb is that a high ratio, say anything over 80, is often seen as a signal that silver might be cheap, undervalued compared to gold. A low ratio, maybe below 60, could suggest the exact opposite. But, and this is really important, you have to remember this is a tool for analysis, not a crystal ball.
So why does this ratio jump around so much? I mean, why don't their prices just move in lockstep? Well, this is where we get to the heart of the matter. It's all about a great economic tug of war.
And this right here, this illustrates that core conflict perfectly. Look at this. On one side, you've got the world of industry. We're talking factories, innovation, all that stuff. And it relies heavily on silver. Its value is all about things being made. But then, on the other side, you've got the world of finance, central banks, big investment vaults, and that's where gold is king. Its value is tied to wealth being protected. Let's dig into that a little more. Silver's price, it tends to do really well when the economy is humming along. It makes sense, right? Factories need it for solar panels, for electric cars, for basically all of our electronics. So when industry is feeling good and expanding, the demand for silver just shoots right up with it. Gold, though, it's the complete opposite. Gold thrives on fear. When investors are getting nervous about economic instability, or they're worried about inflation, or some crisis is brewing, they flock to gold. They see it as a safe place to park their money. Gold's price is really driven by financial anxiety. And history shows this playing out time and time again. I mean, researchers have found that the ratio consistently spikes during recessions. You can see it right here on the chart. This is that fear trade in action. As economic anxiety goes up, investors tend to prefer the safety of gold, and that pushes the ratio higher and higher. And we see this exact pattern over and over again during big crises. The ratio peaked during the Gulf War back in the early 90s, it spiked like crazy during the 2008 financial crisis, and it hit an all-time high of nearly 125 during all the uncertainty of the 2020 pandemic. History is pretty clear on this one. When fear is high, the ratio is high. Okay, so we get the signal. We see how it works, but how do investors actually use this information? Well, it really boils down to two very, very different philosophies. First up, you've got the aggressive, really bullish approach. This is championed by voices like Robert Kiyosaki. He looks at where silver has been, sees a huge opportunity, and flat out calls it the best investment bargain out there.
And the bull case for silver is pretty compelling.
Proponents will tell you it's real money, not like the paper currency we use. It's absolutely essential for the whole green energy transition, and when you compare it to gold, it looks historically cheap, and it's affordable enough that pretty much anyone can start buying it.
But then there's the other side of the coin, a much more cautious, balanced approach. A lot of financial analysts suggest a totally different playbook. They say, look, start with a solid 3 to 6 month emergency fund in cash. Then you can think about using precious metals as a strategic piece of your portfolio, maybe 5 to 15%. The key here is to really understand that silver is way more volatile, and to remember that a hedge isn't a replacement for a bank account.
So, after looking at all this, the history, the mechanics, the competing strategies, what's the big takeaway here? What's the one thing you should really remember? It's this. The gold-to-silver ratio is so much more than just a number for traders to watch. You should think of it as a powerful lens. A lens that lets you see that great economic tug-of-war between fear, which is represented by gold, and growth, which is represented by silver. At the end of the day, it's a barometer of how the world is feeling.
So I'll leave you with a final thought. Now that you have this tool, take a look at the world today. What do you see? Do you see the forces of industrial optimism and growth winning out? Or do you see the currents of financial fear starting to take over? The answer to that question might just tell you everything you need to know about where this ratio is headed next.